Kia ora, I'm David Chaston with 90 at 9, brought to you by interest.co.nz. This week, get everything you need to know in 90 seconds at 9 o'clock. With news, major global trade choke points are under threat, and this may bring very costly workarounds. But first in the US, October factory orders fell sharply and by more than expected. They fell 3.6% from September to be down 1.4% from the same month a year ago. But to be fair, this is essentially a story of a drought of new aircraft orders, down 50% from the prior month. It may still be early days, but the new central bank policy approach in Turkey hasn't yet had any effect on bringing down inflation there. It is still running at 62% in November. In Australia, there are building signs their economy is softening, and quite quickly. In fact, a New South Wales survey of a wide range of businesses found that Christmas trading is expected to fall on average 11% this year compared to last year. Businesses in two of the state's regions are anticipating a decline in excess of 20%. And in those two regions, almost half plan to cut staff after Christmas. Things are decidedly ropey there. And extending the ropey feel, a broader Australian survey found that activity is being propped up by making more inventory. Meanwhile, sales are retreating and profits are under real pressure, although to be fair, the overall picture is twisted by a big drop in mining profits. That wages rose while sales fell doesn't give you a good feeling about the future employment matters either. Canberra is preparing a new round of cost of living relief measures to roll out if things get dire. They are most likely to be released in their May 2024 budget. And later today, the RBA will release its final review for 2023 of its cash rate target and is universally expected to be on hold at 4.35%. Tough talk about inflationary risks are falling on deaf ears in financial markets. Those now price in no change all the way through 2024. But we should all hold our breath. Conflict in the Middle East, a drought in Panama, both mean that the two vital canals for world trade are under threat and operating sharply below capacity. In Russia, the only two rail links from China have been put out of action by sabotage, and that's not to mention South China Sea stresses. In each case, the alternatives are very costly and will sharply discourage trade. It is very unusual that these threats are all happening at the same time. One measure, the Baltic Dry Index, is suddenly zooming higher. The US Treasury 10-year yield is up 8 basis points from yesterday at 4.29%, with yesterday's slide reversed. And the price of gold will start today at just on $2,026 an ounce and down $45 after yesterday's reaching an all-time high. And oil prices have stayed down at just under $74 a barrel in the US, when the international Brent price is still at $78.50 a barrel. These are 4.5-month lows and levels first reached 16 years ago. And the Kiwi dollar starts today at 61.7 US cents and down 40 basis points from yesterday. Against the Aussie, we're up 20 basis points at 93.2 Australian cents. Against the euro, we're still at 57 euro cents. That all means our trade-weighted index starts today at just on 70.6 and down 20 basis points from this time yesterday. Get more news about the New Zealand economy from interest.co.nz. Kia ora, I'm David.